I was asked to give this talk today about the venture capital industry and how to be a great. I feel like Jim Collins, who wrote that book, How to Be Good to Great, and who's got another book that just came out on why companies are great companies. I don't know how exactly. You can leave that there. That's all right. Yeah, that's a good place. Just up or down, right? I'm not necessarily certain how you can be a great venture capitalist, but I can tell you a few thoughts I have about being in the venture capital business and some of the things you might think about. You may find I tested these pictures out and the words to make sure that they translate well, so I hope they work, so you don't think I'm doing something too strange. Well, it's not going page down. Okay, so the first slide, it says, be curious. And you might wonder what that is, but that's a picture of a plate. And I, for many years, have been asked, well, what's the characteristics of a venture capitalist? How do I know if I'm a good venture capitalist? And I came up with this concept many, many years ago. And I said, if you went to a dinner party and you saw an unusual plate in front of you, if you took the plate and you turned it over and you looked at it and said, who made it? That was an interesting test of the fact of you were a curious person. I'm sure I won't even ask for hands. How many of you have ever done that? Probably none of you. But I think it's suggestive of being curious enough to find out something. And I think if you extend that concept not just to plates, but to products or services or articles that you read or papers that you read or attending conferences, I think if you're the kind of person who is curious about what's going on around you and asks questions and doesn't take things for granted, I think that's the characteristic of someone who probably, as an early precursor, would probably make a good venture capitalist. Now, you may say it's very simple, but the truth is that most people in life don't go around and aren't curious about what's going on and don't read something in the paper and then go and check it out. Check out the website, check out an article, check out a person, because if you really want to be good in this business, I think you have to be the kind of person who has that curiosity factor and looks a little further than just the obvious. Now, the next picture I hope you can determine is a target. Be focused. When I started out in this business, it was a very diversified type business. My first investment was in the secondary metals business. The second was in the animal feed business. The third one was actually the first internet startup, but in those days it was called packet switching. So it was such a new industry. It wasn't even an industry. It wasn't called venture capital, but you really were looking for any opportunities you could find where someone was looking for capital. And the concept of sharing and giving a piece of your ownership of your business away was a very unusual concept. It was that, frankly, when Yoshi and his team, when I first met them in 1998, the concept of sharing ownership was a new idea. When I started in Europe in 1977, 78, it was totally a new concept. People couldn't get the idea. They were used to borrowing money, but they weren't used to taking in equity partners with them. And that problem still exists in parts of the world today. In Africa, it's a very big problem. People need money desperately, but they are not used to the idea of sharing and partnership. But the point was that the business has evolved in the more developed areas today, certainly in the United States, where developing expertise in a particular area, I think, makes a lot of sense for someone who wants to really build up their skills in this business. I think developing deep relationships with people who are operating in the area, so that you get to know who the people are who are in the leading edge in technology, and who have, so that you can have an exponential growth in terms of your contact level. We are very, very focused in the digital media area, and one of the biggest strengths of our firm today, Greycroft, is the fact that companies want us as an investor because of our significant network in the digital media and mobile area. So I'd say if you want to be great in this business today, you have to develop a particular expertise, and you have to learn how to focus your efforts. Because if you get too diversified, you'll build no reputation for expertise, and it's a competitive business today. And entrepreneurs want investment from people who understand their businesses. They don't want to educate them from the first day as to what they're doing. Be disciplined. This is a chart about which shows you the investments that were made in the venture capital industry year by year from 1990 to 2010. I guess it skips 2 years at a time. But you can see for yourself the famous bubble of 1999-2000. It's very clear. And that's when discipline went totally awry. People just put money in indiscriminately. They backed people who had no experience in running businesses. Most of the people who were starting businesses were too young. They should have been, working in companies as opposed to starting businesses. And the venture capital business was overfinanced by institutions, and as a result, that's what happened. The investments went from $100 billion down to a low of today, $14 billion in 2010. That suggests that I like to say you want to be an investor when the drums are rolling, not when the trumpets are blaring. Now, I hope that's not lost too much on you, but when everybody's excited, when everybody can't wait to get into the next deal, that's the time probably to slow down, be careful, as opposed to when everyone's discouraged. And I would say that probably, particularly from Japan standpoint, I would think this is probably going to turn out to be a great time to be an investor in Japan, as long as you use appropriate discipline about the companies you go into. I would guess that valuations in hindsight are going to turn out to be very good, and I think there is it's probably a very good time. At the same time, we're going through a period where, because of, my area in particular, because of broadband communications and the spectrum that's available, because of outsourcing, because of cloud computing, because of the mobile networks, the capital efficiencies of businesses that are starting out has never been greater. So you can start businesses with a small amount of money. And so I think that if you're disciplined and you invest in companies that know how to take advantage of capital efficiency and know how to structure their business appropriately, and you invest your own money on a staged basis where you don't just pour lots of money in, I think you can do very well. I happen to believe very strongly at the moment, which is why I started up again from the beginning in 2006, which was to start a fund that was, by design, a small size fund investing in capital efficient businesses. I had many years of experience in building a very big firm, and my Apax certainly has gone from being a venture capital firm to being a mega buyout firm. Their minimum size investment today is probably $500 million, 5 times bigger than my whole fund. But they're not in venture capital. If you're going to be in venture capital, I think you have to learn how to be disciplined about the money you raise, and how you invest that, and how you stage the investments. I am not a big believer in big venture capital funds. I think it's an inconsistency because you end up investing too much at too high a valuation, and the exit opportunities are not commensurate with the capital that you may be employing, because the world has changed dramatically. Not so much for Japan. Frankly, based on my superficial observations, Japan is a better place to invest with an IPO expectancy than the States today. 10 years ago, every company I looked at the end of the presentation would have exited 2015 through an IPO. Today, nobody expects to exit an IPO. The IPO market is very, very limited in the United States. You have to have a company of at least a market cap of $300, $400 million. You have to raise $50 million. And then you have to worry about whether there's research coverage afterwards and marketability. My sense of Japan, based on my experience from coming here every couple of years, is that you can virtually make an appointment to take a company public. You can do small cap IPOs, and there's reasonably good markets afterwards. And certainly Globus, Apax Globus, and then Globus has taken advantage of that. In the States, don't be carried away by, I'm sure you all are reading certainly in the American papers, but the Japanese papers about Groupon and Zynga and Twitter and Facebook. They're a very unique subset of the business. And anyone who gets carried away by that is making a very big mistake. The opportunities, there are probably at least 2,000 venture startups last year, and maybe 5 or 10 will go public. So the rest of them will get sold in some kind of trade sale. And in our experience, the average trade sale is taking place at $70 million. And most of them, in terms of numbers, most of them are below 50 million. So learn how to discipline your investment, size your investment in relation to the realistic opportunity for exit, and don't lose sight of that when you hear all these fancy stories. Cultivate your network. I hope you like these pictures. Try to give you a little illustration. I mean, networking, that's what you're doing today. It's, meet the people who come to the same events you go. If you go to the event and you leave or you sit next to the same person you came with, that's not developing your network. Developing a network is so that you have this ability to be able to focus in an area and be able to call on other resources. The best deal flow comes from your existing network, not from strangers. The amount of deals that are done in the venture industry from unsolicited proposals is so small that the temptation is always for everyone just to turn them down automatically because it's so unlikely that something comes of it. But all of us are creatures of habit, and we still open up those emails and meet with them once in a while. But the best deals come from people that you know, who you've developed through your network, who you can calibrate their experience. I would say along the same lines, and I don't know whether there's another picture that reflects this, but we have learned one really major lesson in this business. The best investments we have made have been with entrepreneurs who start new businesses in areas that are somewhat closely related to what they did before, and where they attract people they worked with before to a team. The highest probability of success. We have a company it's called Extreme Reach, and not important what it does, but it happens to distribute for advertisers, for brands. It distributes the ads across the TV and radio and now digital network. And they all work for a company called Fast Channel, Digital Fast Channel, or something on that line. And the CEO left, He had a 2-year non-compete, and then he decided to go back in the business. And before that, they had been distributing these advertisements through what I call the bicycle network. They would put them in a FedEx box and send them around or messenger them around to the stations around the country. And then it gradually moved to satellite distribution. And with the advent of the internet, the opportunity came to create a capital efficient business that would distribute the exact same ads on a HD basis, high definition basis, through the internet. So he created a company about 2.5 years ago, and came with a team of about 5 people, all of whom who'd worked for DG Fast Channel before. And they were taking a new technology, capital efficient, and with the same group of people who'd worked before, who had experience in the area. Today he has about 90 people, and 70 of them came from DG Fast Channel. All very legitimate, all left with the right, on the appropriate non-compete restrictions. And this is probably the 4th or 5th company we've backed where it has that kind of consistent group of people who worked before. So it's helpful to network, to recruit for your companies. It's also helpful co-investing with the people who go to these meetings with other venture capitalists. We believe very strongly in co-investment. And probably most important is the biggest strength our firm has is we promote to the investments that we talk to, the entrepreneurs, that we will help you building your business because of our network, because of the cultivation of our network. That if you need to meet an advertiser or someone in the entertainment business or in the media business or one of the TV or radio networks, we have built up this extensive network of contacts, and particularly in the advertising world. And most companies in the internet or digital world today need to have advertising content. That's the reality. And so we have become a very popular firm for entrepreneurs because we deliver the introductions through our network. So we run digital media days where we have an ad agency in, and we let them pick from our portfolio, and we bring them and we give a show and tell. We do it for the brands. We do it for the networks. We did one last week for Citibank. We did one for Bank of America. We did one for American Express. And it's an amazing opportunity for our portfolio companies, who are all young companies and desperate to get to the right person, to have a meeting where they can meet 10, 15 people in one place and sell their merchandise or their services. So cultivating your network is extremely important. Identify talent. I assume all of you know who this is better than I do. But clearly, the people at Globus were smart enough to identify talent. And surround yourself by good people. The team you have, don't use the concept of venture partner, which is a venture partner is not a full-time person, but someone who you add to your network, which you probably couldn't afford to hire. Develop an advisory team where you also can access other sources beside your firm itself. We have used that extensively to get better leverage, because our firm, we have actually on our full-time staff, we have there are actually 5 full-time people, but we have 3 venture partners, and we have an advisory group of 5 CEOs from outside companies, and that provides our network to be, again, helpful to our companies. And remember, you've got to help your entrepreneurs in recruiting talent, not just identifying the initial talent, but you've got to also help them. Recruiting is part of the job. We invest in people first. The product is secondary. I would rather have a great person and a great team than have the most terrific product. after the Russia had its change in government and structure, we must have seen, honestly, I'm not exaggerating, at least 10, maybe 20 people come to us and say, I have the access to all the technology out of the Institute of Aeronautics. I have all the technology out of the Institute of Physics. We have, there was always someone coming in with all, and there are 100 people, 100 software engineers. We have access to all their talent. But as I used to say to every one of them, where's the entrepreneur who knows how to capitalize on that talent and make something happen? So talent is the thing that's in short supply, not necessarily the technology or the product itself. So you really want to ask the next question, what makes a great entrepreneur? I think can differ on this, but I think the ability to inspire other people is very important. The ability to attract talent, as I said, particularly people that they've worked with before. An enormous persistence that in the spite of adversity, they don't give up, but they have belief, and not an informed belief, I would say, not an uninformed belief, because there are people who are entrepreneurs who just don't give up, who aren't willing to read the signs and accept the fact that something's not working. So there's got to be a balance there. And I think also as part of that, understanding the economics of the business they're going in. A lot of people go into business and they say, we're going to business and it has a $10 billion market. That is really probably not the case, because the address market is the segment of the market, of that big market they're really going after, and that may be much smaller, and the economics of reaching that market are very important. And I think the one short failing we find in a lot of entrepreneurs is not understanding what the marketing costs are and what the distribution costs are and how to get to that market that they think they've identified. So identifying talent and being helpful yourself in recruiting talent. Venture capitalists is an apprentice business. If you can't tell with this picture, it's a shoemaker. There aren't many of them around in the United States anymore. We used to have one in every block. I don't know about you, but it's very hard to get your shoes fixed. Today you throw them away, I think. But it's an apprenticeship business, which is what shoemaking was at one time. Venture capitalists, I don't think, are just made. You really, I think having instincts, having curiosity, having all these characteristics that I've talked about are important, but you really have to learn on the job, which means starting out in a junior capacity and learning. Don't think you know it all from the beginning. It takes time to develop this ability to identify talent and to judge what makes a good deal and what doesn't. And I think you can learn from others, and watching what doesn't work is probably the best thing you can learn. And the question always comes up, I get asked this, and I'm sure you're asking yourself, if you're not a venture capitalist, should I go in the venture business, or should I go into the investment banking business first? Should I go into a startup? And I think that all depends on you, but I think that coming into the business with some skill level is very helpful. I frankly believe that having been in a consulting firm or having worked for a startup or an entrepreneurial venture, it gives you a better ability to get into the venture business, although some people come straight into it out of business school or out of another industry. But even if you come from another industry, you have the expertise from that industry. So an apprenticeship business means that you're not going to be an overnight success. Empower your entrepreneurs. I like to always say, if you're not the entrepreneur, you have financed an entrepreneur. And if you get confused, which unfortunately many venture capitalists get confused about what their role is, and they become overpowering, and they try literally to run the business And the reason for this picture is if you get too aggressive and too overpowering to your entrepreneur, at one time he may turn to you and say, here's the key to the front door, it's your business. I actually have seen that happen because of venture capitalists becoming too actively involved. I tell the story of someone who worked for me many years ago, and he was very, very smart. He was a physicist by training. He had taught at Princeton, as a matter of fact, and he had worked at a company before, and I hired him. He was out in my West Coast office, and we weren't doing that well, and we weren't networking well enough. We weren't getting involved in enough of the good deals, and I got concerned, so I decided to move out to California for a month to see what was happening. And in the venture business, very often the venture capitalist will be the chairman of the board. The chairman of the board, in the way I interpret chairman, and I've been chairman of several companies, is you preside at the board meeting and you say, I will now turn over the meeting to the CEO. The CEO then runs the meeting. That's the function of a chairman. He convenes the meeting. He provides some stature, some gray hair perhaps, some overall perspective on the business, on grander matters, but he doesn't try to run the business. So I had this fellow there who was very smart, and I couldn't find him most of the time. And he was chairman of a bunch of companies, and he was always out at a meeting, and I would find that he'd have these meetings at 6 o'clock at night, and he interpreted the role of chairman of really running the business. So he was having marketing meetings for this company, and he was having technology meetings for this company, and we had an investment in a company called Johnny Rockets, which was a hamburger chain. And I got called up one day while I was out there by one of the board members, and they said, we're removing this particular person from the board. He was chairman of the board. And I said, please don't do that. It's embarrassing, but why is he doing it? Well, he said, he is now ruling, or he has told the business that they can cook the hamburgers at whatever it was, 99 degrees instead of 97 degrees, because he's determined that's the temperature at which hamburgers should be cooked. And I said, this is really, we've now gone to an extreme where the venture capitalists in the business has gotten so involved that they determine at what temperature to cook the food. Needless to say, he didn't stay in that company very long, I don't think more than a day more, and he didn't stay in the venture capitalist business very long. But the illustration is to point out that you just can't get too involved in the businesses. You can give guidance, you can give support, but you must empower your entrepreneurs. They've got to feel it's their business, not your business. Along the same line, I think you have to develop a relationship with your CEO. It's a very lonely job being a CEO, particularly when there are problems. And believe it or not, it's hard for a CEO to talk to his vice president of marketing, or certainly his lower employees, to tell them and share with him the problems that he has. The venture capitalist should be, if not his best friend, it should be someone he feels he can talk to and confide in about the problems that he's going through, and to get a sympathetic ear and a constructive ear. So I think that it's a very important thing to build up relationships with your entrepreneurs, to let them feel comfortable that they can tell you the things that they're going through that are their problems. And these relationships should last for a very long time. I have many, many entrepreneurs that I still keep in contact with, that I was on the board or in the early formation of their businesses. And I think that is an important illustration of whether you're building your relationships. And from that, I think you build a reputation for yourself. I hope you all know what this is. like to say that when people ask me about what I do for a living, and I say I'm a venture capitalist, and they say, well, what's that? I said, well, I'm a doctor of investments, and every day one of my patients is dying, and it's never the same patient 2 days in a row. That's the venture capital business. I'm sure for those of you who are in the venture capital business, you know what I mean. Venture capital is not all going up in one direction. It's not all positive. Frankly, it's just the opposite. It has lots of problems because businesses have lots of problems. People quit on you. Financing gets tight. The product doesn't work. The market has been delayed for a year. All those things come about. I think you have to, in terms of these, I talked to you about relationship with your CEO, you have to also be prepared for adversity. And you have to understand that it just goes with the business. And people forget that, I'm not a big sports fan. I like to play sports, but I have 3 sons, and they are crazy about watching games and covering statistics. But it's interesting that, I don't know if these names will mean anything to you, but the greatest ball player in the United States that ever lived was a man by the name of Ty Cobb. Anyone ever hear of him? No. He was very, very famous. And Ty Cobb, like Lou Gehrig, Ty Cobb's batting average was something like 365. So what it means is 1 out of 3 times that he came up to bat, he got a hit. The other 2/3, he struck out. So his batting average is 1/3. Michael Jordan, who's probably the greatest basketball player in the United States, his hitting average, his shots in the basket run under 40%. So the realities are, in most businesses, you have a loss ratio, and venture capital is probably one where the loss ratios are higher than that. People usually say, 20%. There are many funds I've seen where the loss ratios are as high as 30%, 40%. You certainly don't invest with the expectation you're going to have that kind of loss ratio, but you have to be prepared for losses, and you have to be prepared to deal with adversities. This is very important. It goes with curiosity. If you're going to be in the venture business, you have to like multitasking. If you're someone who says, don't bother me, I can only focus on one thing at a time, don't go into the venture capital business. Because you not only have to focus on many investment opportunities at the same time, but they're all different CEOs, they're different locations, they're different problems, and not only do you have to look at a lot of different businesses at the same time, but after you're in the business, you have to be able to be helpful in recruiting, you have to be able to be helpful in financing, you have to be a good board member, you have to be a good investor, you have to be good to help them in business development. So it's a very diversified field of activity. And unless you like that multifaceted part of the business, I would strongly suggest not coming into the business. I would say, and there's nothing wrong with it. I mean, Steve Jobs had a focus on building his business, and he would have hated the venture capital business, I'm certain. And you could go through many other people. Howard Schultz built Starbucks. He was totally focused on building this coffee chain. He's been doing it for 25 years, and he loves it. I'm sure he happens to have a little venture operation on the side, but that's not where he spends his time. But if you like, and I think that there's a lot of satisfaction that comes from being an entrepreneur, to build it and to say, I started it, I grew it, these people all work for me, I have something to be very proud of. The venture capitalist can only say, I'm proud of having invested in that company. I'm proud of having been, and I wasn't the original, I was the second investor in Apple. I'm proud of having invested, but I could take no credit for the success of Apple. Steve Jobs deserves the credit for Apple. So if you're the kind of person that, likes to be involved in a lot of things and thrives on that, then you'll be a great venture capitalist. If you don't, I would say be an entrepreneur, build a company, and focus on building that to the best you can. So those are my suggestions of things that would be helpful. I think that being also a person who is meticulous about what they do, is focused on detail aspects of analysis and of fact-checking, of reference checking, all the things that are mundane are also go with the business. So you have to be really willing to do that intensive analysis besides just using your instinct. I think you want to be someone who's willing to put the time and effort to determining the good entrepreneurs, determining the good business models, and then sticking with them afterwards.
So Alan, thank you very much for your speech. I believe that it's been about 8 years since you made a speech in Tokyo. And I tweeted that this is a very rare occasion for us to be hearing from the legend of venture capital industry. Thank you for coming, and thank you for a speech. And I have asked quite a few venture capitalists in Tokyo to come over here, as well as staffs and also some of the students from IMBA, which is a business school in English, taught in English here, and for this occasion. And so I'd like to ask some questions, about what you have said. First of all, I can't stand asking you about Apple, how it was when you invested it, and what kind of personality Steve Jobs was, and what kind of impression you have when he passed away. So could you please tell us about Steve Jobs and Apple?
I want to be, honest. I always am about what I've done. I really did not have an active role in the Apple situation. I had a much more active role in AOL. But when I met Steve, he was, I think he was like 27, 28 years old. It was 1979. And he had started the company in 1976 or 77. And it already had, was out in the marketplace. And there was an opportunity to put in a relatively small amount of money. We invested $500,000 at that time. And I can't even imagine, I don't have the records anymore to understand what the valuation was, but my guess is it was probably about $20 or $25 million as opposed to now 84, I think it's 84, no, I can't remember now, it's 84 billion or no, $350 billion, 84 billion in cash. I mean, I laugh sometimes and say if we had just held our stock from that investment and I went to the South Pacific and just went on a desert island for the next 40 years, 30 years, I would be a very, 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 very rich man, which gives you tells you one thing. Sometimes it's, if you have something good, just hold on to it and don't do anything else. But he was a very dynamic, very detail-oriented person who was kind of driven at that time, not your, sophisticated Harvard Business School graduate. He was very much, remember, he was one of the last people, I think, that I've seen that actually started a business in a garage. They went public a year or two afterwards, and we sold out our interest in sometime in the mid-'80s. I don't remember. Actually, we distributed the stock to our investors, and I can't imagine any of them still have only the stock, but who knows. AOL, on the other hand, AOL, people don't know, actually had gone into bankruptcy when it started. It was a game company. It went into bankruptcy, and it came out, and I helped to take it out of I wasn't an investor before. I was an investor when it came out of bankruptcy. And I was very helpful, actually, in introducing them to Apple, as strange as it may be, and setting up something called Apple Link, which was, and getting an investment from Apple at that time, which was a very strategic, very strategic importance for AOL. I also helped introduce them to a small technology company, which became the core of their technology. This was in 1984.
Thank you, Alan, for telling us about 10 steps to be a great venture capitalist. First thing you said, it was curiosity, and you're always curious about things, and then Alan always pushes us to be curious. And second is focus, and the focus is so much important. Third is disciplined investors. You mean discipline? So how could you become disciplined when there was a bubble going on and there were lots of passion and enthusiasm for internet, and there are lots of high valuation? How could you maintain your discipline?
It's very, very, very hard to do. But all I can say is that if you think that something is crazy priced, it's overpriced, the market is in a bubble, it doesn't make any sense, trust your own instincts. I mean, we're going through this right now, and we're going to see tomorrow, the next day, Groupon is going public. And I'm sure you've all read about it because it's been all over the papers. It's in the papers, on the newsstand, on the television every day in the United States. And a month ago, they were going to go public at $30 billion. This week, they're talking about going public at $11 billion. So they've lost $20 billion of value in the sky someplace. And no one knows exactly where it will settle in. I'm not going to give you any projections. I don't know anything. I'm not an investor in it. But a lot of people have invested actually in private transactions, a lot of well-known people, at a $10 billion valuation in the private market with the expectation that it's going to go crazy. At the end of the day, Groupon, like any other company, is going to sell based on its growth rate, on its how much it costs to acquire a customer, what its retention rate is, what the stores or the manufacturers who give them product, how successful it is to give these deals out, and ultimately what kind of profitability Groupon has. We really don't know the answer to that now. And so as a disciplined investor, someone ought to be very careful in kind of extrapolating and figuring out what the economics are. And I've never seen a business with more competition. There must be 150 at least in the United States, and I don't know, how many Groupon lookalikes are there in Japan?
A lot.
100?
A lot. Like let's say, I think you know that. How many Groupon-like companies in Japan? About 10 or 20? At least 80.
At least
okay.
80.
That's a lot.
I mean, it's not a proprietary technology, that's for sure.
Okay. So third was discipline, and fourth was network. How do you cultivate network? And I was
Be curious.
Be curious.
Go
and
be active. I mean, you can't sit at your desk.
Okay,
you have to be
go
someone
out.
who's willing to get up. In our world, you have to go to meetings at night. You have to go to meetups. You have to go to conferences. You have to talk to people in the industry. You have to be willing to exchange cards and not just go through the ritual, but actually follow up and get to know people. And you have to exchange ideas. Yeah. It takes effort. And I tell you, I have hired people, and you can tell within a few months they're just in the wrong business because they don't have that initiative.
I read an interesting article and research on entrepreneurship, and the research was talking about you can judge who is a great entrepreneur the way he or she drifts in the network. If you observe how he or she is like a network within
Watch them in the room,
in the party, you can find out who is a good entrepreneur. And the research report concluded that there is a correlation between good entrepreneur and good networker. So maybe it's true. I was quite curious to know that you put this into fourth step, and I totally agree. Networking
I
is
did
so much
not, by
important.
the way, put them in any particular order of 1 to 10.
Okay. But it's fourth one. Fifth one was develop skills to judge talents. This is tough, isn't it? Like, how do you develop skills to judge talents. And
It comes from being around long enough to
Okay.
be able to, you know, say this is someone who I think has the character. And doing reference checking
okay,
and, you know, finding out how people were on the job, what they're, you know, whenever I do a reference check or we have people, you don't call in, when they give you lists of all the references, they only give you people who are going to say something good. So you usually say to them, can you give me the name of someone else to talk to? Or you say to them, everything about Yoshi is terrific, except, give me, I want to know about the exceptions. What should I have to watch out for? Because that's the thing you want to know is what you have to watch out for, not all the good things.
okay. And then you talked about apprenticeship. And I think it's quite similar to what you mentioned about skills to judge talents as well as apprenticeship. So how do you educate venture capitalists? Like, how do you think, you know, like, what is the best way to, you know, educate them and then make them become a great venture
No,
capitalist?
what I'm really saying is I think someone who's been in the business 3 or 4 or 5 years is better than someone who just, they're not going to come in the first year and have all the right instincts. I think actually having some adversity and some problems and learning how to deal with those skills makes them a better venture capitalist. Someone who's had the time to build up their network is better. All those things help to make someone a better venture capitalist. I mean, I think the idea is don't expect to go in and you know, be great right out of the box.
You, like, Alan has been my mentor, so he always tells me about what to do and so forth. And you use quite a few words, like you use quite a few times about instinct, like the smell and instinct.
Well,
What
you
does it
develop
mean?
that, but I think you develop that instinct over a period of time. You don't get that initially. I think you have to see where you make mistakes. I mean, my father used to always say, play the stock market on paper first before you play with your own money. I think here, you know, sit in things and make your judgments quietly and see how it turns out and see how your instincts are and keep your own track of how good you are in judging and then, you know, learn what characteristics work and which ones don't.
So some good venture capitalists always be able to make some good investment and make the companies to be grow. Some of them will not get there.
Yeah, I mean,
So it's a
I
very
still make
diverse-
plenty of mistakes today. This is an art, not a science.
Okay. So number 7 is empower entrepreneur. Kids. That's a good one. And empower entrepreneurs. I remember when I started venture capitalist, I tend to feel that I am entrepreneur. But you know,
That's a very big
after 3 or 4 years, you know, you find the limit that you can do. And
It's a
therefore
very
you-
natural tendency.
Yeah.
I have it. You have to keep yourself in check. You inevitably say, "Gee, if I were running this company, I could do a much better
yeah,
job."
sure, yeah. But you're not the one who is running it.
Yeah,
right?
exactly.
And 8th one is relationship with CEOs. How do you actually develop relationship with CEOs? You know, like, what is your key? What is your secrets to be able to build relationship?
I think you have to have the kind of personality that you can develop, build their confidence, and you do that by having skills that you really that are substantive, where you really can be helpful. If you're really just saying things and you don't have the ability to be helpful, you're not going to have a relationship because it won't take very long before they say, this is a waste of my time. I've got to focus on my business. He can't really be of help.
The 9th is adversity. Prepare for adversity. How do you actually prepare for adversity? And what do you mean by like actual things that you have to do to prepare?
Well, maybe the word is prepare, but it's be prepared. I don't know. Did I say prepared? It should be prepared.
Yeah, be prepared.
I said be prepared. Okay, which means don't be surprised when you have problems. Do you know anything about problems in your portfolio? It goes with the territory. I mean, you know, there are always problems, and so I think rather than running away from them or just, you know, avoiding them, it's to be prepared for them and act quickly to do something about it.
And 10th one is a diversity. So those 10, and I'd like to ask one or two questions and open up to the
Diversity
floor.
means to enjoy, no, is
To enjoy
to
diversity.
enjoy the profession. You should be prepared for a diversified experience.
Yeah, I'd like to ask two questions and I would like to open up the floors. What has been the good investments? You know, like if you were to choose one good investment, which deal would you choose? And I'd like to ask what is the one bad, investment they have made? I think it's difficult, maybe difficult to.
It's very hard
yeah.
to pick. I mean, I've made so many bad ones that it's very hard. I can just tell you one. I mentioned that we already did an animal feed supplement business back in 1972. But the guy who was very, very talented, he really was a great scientist. And I remember his words, every step in the chemical process of developing this supplement, which was to take waste oil and convert it into animal feed. And he said, every step that we're doing in the process has been done before. What he didn't tell me, what I didn't understand, is yes, every step had been done before, but they had never been done before together. And it was the together that didn't work. I can almost remember some of the technical words, the steps that were done. But in terms of a success, that's like really saying, what's your favorite child? Which is the favorite of your 5 children? He has 5 children, so ask him, which is his favorite? It's very hard. I would say that I can give you a couple of examples. I mean, the ones I think you get the most satisfaction of, in my opinion, are the ones that you had something really actively to do with. I mean, as I say, Apple, I have to, I don't want to be dishonest and say I did this or that. I did nothing for Apple. Apple did itself. But I was very involved with a medical electronics company, which we started with $50,000. It wasn't in a garage. It was in a dentist's abandoned dentist's office in a remote part of New York, and with a concept of developing a cardiac monitoring device, which was designed for a doctor to carry in his bag when he made a house call. Now, I don't know about Japan, but in the United States, you can't get a doctor to make a house call today. It doesn't exist. Can you get house calls? Will they come to your house and if you don't feel good? No, it doesn't happen. But it used to be, a doctor would come with a little bag, and this was a scope that you could put into the bag. And we spent 6 months, and it was very early on, and I was early in my career, so I was very helpful in terms of financing the company and helping to recruit. And the CEO really went around to so many doctors' meetings and doctors, and finally realized that doctors don't like to spend money. They're the cheapest people. They just don't like to spend money. Besides which, the world was changing. What you did is you took this scope and you'd plug it in the wall next to the patient, and you could monitor his heart in a very small scope. And so instead of going out of business, we talked about what else could you do with this technology? Since the doctors, I mean, you could have drowned by saying, I'm determined this doctor needs this, he should have it. Instead, we ran around to the hospitals and went all around in the hospital to say, where could they use this small scope? And we found that the anesthesiologist in those days was really, even though he kept people alive, he was very unimportant in the operating room. It's really the surgeon who's the genius, who has the delicate fingers. But the truth is, the anesthesiologist gives you the oxygen to keep you alive in the right proportion. And so we found that the anesthesiologist had to look at the surgeon's scope, which was at the other end, perhaps, of the room, and he was not treated very well. So we took this little scope, put a tripod on it, grounded it, and came out with a scope for the anesthesiologist in the operating room, and the hospital paid for it. And from that start, we built a $600 million business over 20 years. And I take a lot of pride for having been involved with that in every step of the way in building that. I was on the board for 20, 25 years.
Very good. So we have half an hour left. I'd like to open up the floor for questions. And for those of you who do not feel comfortable in English, you can speak in Japanese. I can translate to Alan. So anybody?
Michael Case, I actually teach here at Globus, and on the side I run a recruitment firm. And we started up probably 18 months ago. Things are going well, 17 employees. But I wonder, for the benefit of other entrepreneurs in here, when you don't want VC money and when it makes sense to not take it. Because, you know, for us, we have, you know, positive cash flow, we have, you know, great internal IRR. You know, unless we needed to expand globally and needed millions of dollars for that footprint, in the medium term, we really don't need a lot of outside investment. So I wonder if you could just address that and think about when it makes sense for there may be times where VCs really want to invest, but maybe the entrepreneur should hold back a little bit.
No, I think it's a very good question, and there's an answer for it. I think if you are thinking in a narrower sense, a more localized sense, if you were opening up a beauty parlor, I would say, what do you need venture capital for? I mean, you know, go to your friends and relatives and angels and get a few dollars to help you start. If you wanted to open up a chain of beauty salons all over the country and you had a new technology or a new concept, I would say, you know, you better make sure you've got financing that'll, you know, carry you there. I think if you're going to take venture money, you have to be prepared for certain, not restrictions, but you're going to have to be organized. You're going to have to end up having a board. You're going to have to end up having good accounting systems. You're going to have legal agreements. You're going to have to act in a more formalized manner. And I was mentioning Africa before. I mean, there's a big struggle going on in but it's happening. That they're totally unused to having accounting. They all keep double books. That's a very common thing in a lot of countries, to keep double books. They have cash accounting, and they don't want to go to GAAP accounting. I think if you're going to take venture money, other things go with it, and you have to be willing to put together a real business plan, a budget, all those things that are uncomfortable for a lot of people, certainly at an early stage. So I think you have to mentally say, if I'm going to take venture capital, a lot of, I don't want to say restrictions, but a lot comes along with it. And unless you're really thinking in expansion mode, I had a friend of mine many years ago who came to me, who was an art dealer, and he wanted to start a new art service in London. He was in New York, he was moving back to London, and he wanted to raise, I don't know, $250,000. And I said to him, I think you're crazy. What you should do is sell 2, 3, 4 paintings, take the profits. You will so regret being in a service business like an art dealer and having me own 25% of your business. It will be a very unhappy relationship. He took my advice. He's a hugely successful dealer today. He loves to tell everybody that, you know, my advice is what kept him to own 100% of his business. So I think if you have that kind of a service business, you know, people forget some of the best financing is from your suppliers and your customers. It's a great indication that you're any good. If you're going to start a business and you can get your suppliers to give you 6 months credit, if your customer will pay you in advance, those are techniques of how to build a business without having to raise capital or get to a certain point where you then can raise capital at a much higher valuation.
Great, thanks.
Very good. Any other questions?
Japan is going through a period of transformation with disasters and prolonged recession and political...
What did you say?
Prolonged recession and disasters and political stagnation. Can venture capitalists play a part in actually transforming an economy on a large scale, do you think?
Actually, Yoshi and I were just talking about that a few minutes ago before we started. The answer is yes. I think that entrepreneurship is critical. The whole startup environment is critical to society today. New York is a good example. New York, if you had gone to New York 5 years ago and you had a technology meeting, if you got 20 people, I would be surprised. There's now something called a New York Tech Meetup, and they meet once every month, the first Tuesday of the month at 7 o'clock. There are 1,000 people. 1,000. New York is boiling with startups, and it feeds on itself because, remember, every startup, once it gets financed, the next day, it increases employment, as opposed to a buyout firm where the next day they're improving productivity by laying off people. So the venture business, and I mean, I'm not trying to get credit for it, but I'm saying startups in general and having an ecosystem that is startups, expansion, it increases employment, and ultimately those companies that are successful in, like a Google or a Facebook, they spawn other startups. And so I think it's critical to have a vibrant startup community, and I don't know how active it is in Tokyo now, but I can tell you that we are in New York and Los Angeles, and both places are exploding with new business formation, incubators, accelerators, meetups. There's a meetup, 10 meetups. I don't know if you know a meetup, but there's a business called meetups. And meetups you can form a meetup. You could do one here because the technology is up online. There's a company called meetup.com, and you can form a meetup for people who make labels for meetings. And all of a sudden it goes on the internet. We're going to meet on Wednesday night, and be surprised, 20 people will show up. Well, that's how and there's a meetup for everything today. People who make hangers, people who make beverages, but mostly technology people. That's the kind of community you want to encourage, where people are talking to each other and exchanging ideas and forming new businesses. And as I say, New York and Los Angeles are very hot today. Silicon Valley will always remain the hottest. New York is right now has a RFP out to form a new high-tech university. And I happen to be on the committee that's going to review the applications, but there are people from universities from all over the world who are trying to start up a university in New York from scratch, have to finance it and everything, which is designed to encourage the ecosystem.
His question is, venture capital industries are being diversified by having incubator, accelerators, and there's an impact investment method, which is now, he heard, is quite common. What do you think about that in the movement?
You happen to ask someone who knows something about that. I know a great deal about it. It's called social impact investing. Mm-hmm. And it's a very active new movement that's, it's been around for several years, but in the last year, through the Clinton Global Initiative program and through the Rockefeller Foundation and a whole bunch of people, that they now have brought everybody together, and there's a global social impact group that has about 100 members. You're aware of it, I assume. And the head of it is a guy named Ron Erdos, who happens to be a friend of mine. And it really is designed to encourage nonprofit organizations or philanthropists to make investments in businesses around the world, not so much in the United States, but somewhat, but really in the developing world, to for social, not just purely financial. So they're making bed nets to prevent malaria in Africa. They're doing water systems to improve water, clean water. the obvious areas: education, water, health. So they're encouraging people to form companies to be helpful to society, but they're revenue-producing businesses, but they're less focused on getting very rich, but more in doing something good for society. And there's a fund called the Acumen Fund, you may have heard of, that does that, run by Jackie Novogratz. And there are many funds being started like that. So they're, I mean, it's a new concept that's not, we don't know what the ultimate result, but they've gotten together now and formed a group of people who exchange ideas in that.
How does the capital come from? Like, how do they raise capital, and what is the expectation for return?
They're getting them from philanthropists. They're getting them from people like Jeff Bezos, or from Jeff Skoll from eBay, or what's his name from the other I can't remember now, from eBay, who have become very big philanthropists. They're getting them also from institutions who are getting socially conscious, and there's pressure and says, you know, you have this big fund of money, you should give a little bit for social impact investing.
So it's a fund, but they say that the return will not be expected to be high.
Yeah, exactly.
Okay,
so they're getting people maybe who are even pension funds who
Sure.
are for-profit investors and saying,
Okay.
take a little bit and do some good with it.
Okay, that's a good idea. Any other questions?
My question is very general. So you mentioned about the be a discipline. I just interpret it as a don't gamble. And also be prepared for adversity, meaning have a reasonable expectation for the outcomes. But you never mentioned about the word risk. So I just wonder if the venture capital business is a risky business, or is there any way to cultivate or expand your personal capacity to accept or tolerate the calculated risk? That is my question. Thank you.
Well, I think you're always trying to mitigate risk, but it's a business. I mean, you know, without a risk, you don't have reward. I mean, we all know that. I mean, you can buy treasury bonds and take. You used to be able to buy treasury bonds and not take any risk. Some countries, there's a little more risk than others. But theoretically, that's why, you know, you buy treasury bonds with a 10 basis points yield. Venture capital is on the high end of the risk spectrum. Let's be realistic. I mean, in the private equity business, my sense is, you know, buyout, that they don't expect to lose money on anything. They don't expect to have bankruptcy. They do, but they invest with the idea that they'll have zero losses. Venture capitalists, you know, understand that you're going to lose some of the companies. We've sold 12 companies so far, 4 at loss and 8 at profits. I think our loss ratio will probably be very good, which is about 20%. I think that's very good. I think most firms would be higher than that. But you can mitigate risk by making sure you're adequately financed, that you've got talented people running it, that you understand the market, that you understand the technology, the developing the product. I mean, those are all steps you take to get a winner. You know, all the things I was talking about, getting a team that's worked before and that knows the business, understanding the economics of it, helps to mitigate the risk.
Soichi. So thank you very much, Alan, and it's been a pleasure having you and making a presentation on venture capitalist. I have asked Alan to make this presentation simply because, you know, we thought that we like to learn, and I was wondering how to learn would be the best way for Alan to be speaking about how to become a great venture capitalist. So with that, I'd like to hand over to Soichi to make a final remarks.
Poor Soichi, he didn't plan this.
Thank you, Alan, for your great
can make it
speech.
short, Soichi.
Yeah, yes.
Okay.
And I just remember the first time Yoshi and I visited New York to make a presentation for the joint venture of Apex Globis. That was 13 years ago. And at that time, Alan, did research to open up the Japanese office of venture capital. And there are lots of offer to him, bank-affiliated venture capital, security firm affiliated already at the time large venture capital. But he took us to be a joint venture partner. And we asked him, why us? And he said he'd like to work with the entrepreneur, not the organization or already big firm. And the essence is, we felt at the time is, the essence of number 4, pick up the great talent. And he always, picking up great talent to be, not right now. And as a student of venture capitalist, I think number 5. And we like to continue to pick up the good talent to be, not right now, but in the future, and taking risk and taking work with them, and to build up, next future great companies. And that's what we learned for over 30, 40 years from him. And as there are lots of venture capitalists in Japan right here, and we as the venture capital industry would like to continue to help up the Japanese companies to going out to in a global world, and I promise we'll continue another 30 years until the age of 76 from now on, and we work together. And thank you very much, and that's my remarks and goals.